What if everything you've been told about using other people's money, or OPM, in real estate was either misleading or maybe even borderline illegal? In this episode, we peel back the curtain on the OPM myth that's been sold to newbie investors for years. From fake gift letters to risky private lending, we break down what actually works, what gets you in trouble, and how to build your portfolio without blowing up your finances or your relationships. You'll want to hear this before you borrow a single dollar for that next investment. Here we go. All right, Canadian wealth secret seekers, I'm here to dig into, yes, none other but the OPM myth. You can hop on Instagram, TikTok, Facebook, any of the social media platforms, and you'll probably see some real estate guru out there talking about how they got rich from not using a dime of their own money. Could be true. Maybe it's not. I'm not here to say whether that is a fact or fiction. But what we're going to talk about here is the truth about OPM and when it makes sense to use other people's money and maybe when it's not worth the risk. So let's start where we really need to begin, which is first and foremost, making sure that we don't do something illegal. When we go to a traditional lender, typically an A or a B lender, they're going to want to actually know where your down payment source is coming from. So if you're buying a property, whether it's your primary residence or whether it's a rental property, they're going to want to see, where's this down payment coming from? And has this been factored in to the numbers for the purchase? So that's why you'll see they want to, see usually up to 90 days of your account balance where the down payment is being held. They want to see that, money has been sitting in that account for at least 90 days. Now that can be incredibly, annoying maybe for some, especially if, let's say, you need to move the money around. But what they're trying to do is just to make sure that you don't have any additional debt that they don't know about. So it's not that you can't borrow money in order to invest in a property, or you can't borrow money to, say, buy your own primary residence, but they are going to look at your financial picture to try to see if this is a good idea or not. Is this a good risk to take for them as the investor, or is it something that might actually cause some problems? So typically they want to see that money, what they call seasoned, in an account for 90-ish days. Now, some people have been have heard this idea that, you can get a gift letter, for example, that it's going to get gifted from parents or it's going to get gifted from somewhere. Once again, if it's true, if it's real, then of course, have at her. That money is coming to you and you don't have to pay it back to anyone. That's fine. But if you're going to use other people's money, you really need to look at your financial health to make sure that you're not putting yourself in a position where you could be not only doing something illegal if you're actually lying. We don't want mortgage fraud to take place here, but also we want to make sure that this is in your best interest. So if you need to borrow funds in order to buy that real estate property, the next question then becomes is, what are the rates going to look like and sound like? If you're borrowing from, say, a private lender, that private lender, first and foremost, is going to want to see your own personal net worth statement to see what have you done in the past? What sort of assets do you have? Because let's be honest, they do not want to have to come after you to get that money back if you're unable to make payments, right? So it's not as easy as going out and getting other people's money. Now, if you have assets, so you have a solid net worth, you have solid income, and here's the other aspect, you have a history of actually doing this type of thing. We'll talk about specifically buying real estate as an investment, not your primary residence, but they're going to want to see that you have a track record and that you actually are running numbers, you're penciling things out, and they look solid. The problem is, if you do have a track record, if you do, have a solid net worth, if you do have those things going on, oftentimes the real question then becomes is, why am I leaning on private lending at all in order to make up for, say, that down payment amount? So what I'm going to argue is that using other people's money for 100% of financing a deal is a really, really risky proposition. And it's something that you have to be very, very cautious about. All right. So, us, we like to have conservative strategies. We do use leverage, but we do like to do it conservatively. So what I'd like to give you is a couple ideas on how you can legally use other people's money and do so in a way that may not put you in a risky situation. What I'd rather see you do is, if you are thinking about trying to keep some of your own powder dry, as we like to call it, so keeping your own money there for just in case, you can still reach out to others. And, we've talked about them before. You might reach out to others to do, say, a joint venture. Now, again, if you're just getting started, oftentimes like the challenge here is like, a lot of people who need money are also just getting started, which kind of gives you two battles that you have to sort of win here. Because if you want to lean on a joint venture, your challenge becomes not having a track record. So who's going to want to lend you that money? And then on the other hand, you also don't have the money yourself, and therefore you're in a bit of a tight spot. So this can be a really, really tough thing. Finding a joint venture partner, and we've discussed this in a recent episode, where maybe you're both new and you're able to use some of each of your money. Now you're going to get half of the upside, might be a better alternative for you, especially when you're getting started. Now, if you have the experience, you've done real estate before, and you just want to start using less of your own capital and you want to start using others' capital, there's some risk involved in that still, even though you have some experience here, right? Even though you have that experience, the real question is now you're going to have to probably give up some of the deal in order to use all of their money, which is fine. But it also means that you're probably going to be doing most of the legwork, which means you're kind of taking on a job. So you have to really look at this from a big picture, from a big picture perspective. It's great to know that if I put $0 into a deal, that I get an infinite return, right? If we do the math on that, right? $0 divided by, essentially any number, any return, a dollar or more that you earn on $0 is going to give you an infinite return, right? You'll get an error in the calculator because there's no way for us to calculate how much that $0 is compounded, right? So you getting an infinite return, which is great, but you're probably going to be doing a lot of the heavy lifting and for only half of the upside. So if you do have capital, if you do have net worth that you've been growing, it's actually a much better move for you to either bring some or all of the money if you can, and potentially even get someone else to do all of that work for you, right? So you have to start thinking about this in a few different ways. So really trying to define for yourself, what kind of real estate investor are you looking to become? Do you want to become a passive real estate investor? By the way, not really a thing unless you're just the money partner. Or do you want to become essentially an active real estate investor as a career, right? Because you are going to be putting a lot of time and effort into it as well. These are things that we have to think about as well. All right, moving on from, say, a joint venture as an option to use other people's money might be the family lending done right strategy, where you're looking at others in your family or friends circle. These are people that know, like, and trust you, making sure that you are very clear on what the goals are and that you've got a clear game plan as to what's going to happen, and specifically knowing and telling them what will happen if something goes wrong, and being very clear that something can go wrong, right? Just because you're doing this and because maybe you've had some experience buying and investing in real estate doesn't mean that this next property isn't the one that's going to cause you, problems, right? So always being very clear and transparent, making sure that you create, whether you want to call it a contract or an agreement or an understanding, making sure that everybody's on the same page so that you don't actually create a family feud out of this situation can be really helpful. Now, strategy 3 is using your own home equity line of credit, but doing it smart and legally, which means that you'd have to tell the actual lender that that's your intention here. Now, if your line of credit is all you have to your name and there's no other assets there, lenders might still have a problem with that. But if you do have other assets or other liquid capital that you just want to keep on the sideline, dry powder, feel free to consider using your home equity line of credit. They're going to want to make sure, though, that the interest being charged on that home equity line of credit is going to be able to be covered by you and or the property or both, so that they're not getting themselves into a tricky spot. And of course, in turn, you're not getting yourself into a tricky spot as well. So I'm a big fan of utilizing the home equity line of credit, but I'm certainly not a big fan, as you heard in a recent episode, just a few episodes back, not a good fan of doing so if that's your only line of safety, meaning that's where your dry powder exists, is in the equity in your home, and you have no other assets there. So be very, very cautious when you're thinking about utilizing this strategy and making sure that you've done all of the math. Can you float the purchase of this investment property should a tenant, for example, stop paying rent for an entire year and you have to maintain the mortgage on the investment property, maybe the mortgage on your own primary residence, and the interest on your home equity line of credit? Are you going to be able to do so in order to squeeze your way out of that situation? If that makes you sweat right now and it makes you worried about how that might go if something doesn't go very well, then I would argue that you are not doing yourself any favors by over leveraging yourself and trying to use 100% of other people's money. So lots of strategies here. Know your numbers. Make sure you understand what you're going to need for a down payment, any renovation budget that you might have, and holding costs. We want to always build in a buffer for surprises. This is your capital expenditures account. What if the furnace goes, the roof goes, the tenant stops paying and the landlord tenant board doesn't help you? What if any of those sorts of things happen? What is your next move? How are you going to feel emotionally when the money stops coming in and you start second guessing yourself, right? Are you able to follow through and ensure that you don't go and do a fire sale or do something silly that's going to put you in a bad spot? All right. So make sure that you're thinking about timelines, thinking about what you would do for 12, maybe 24 months if things didn't go well. And we would argue that you want to be saving at the very same time as well. So not only do we want to wait to buy into a property so that you not only have the money to do so, or at least a good chunk of it to do so with the down payment, but you also want to make sure that there is liquidity available to you should something go wrong. All right. So what I'm going to have you do right now is start thinking about, how do I get in? If you're just starting this journey, thinking about, how do I get into the market, running numbers, penciling numbers, and maybe even viewing properties so that you can try to determine what kind of property am I after, making sure your goals are clear and making sure that you're on track to save up enough money so that you can actually make this transition. If you're finding that it's impossible for you to put that extra money away to start building up that opportunity fund, that's a red flag, right? It's a red flag to you that, guess what? If you take on more expenses, it's only going to become more difficult for you to get yourself out of a mess if you're struggling right now to start building up that opportunity fund. So today, key takeaways is that using other people's money for investments is not a cheat code. It's a tool, and we want to make sure that we use that tool very conservatively and very cautiously. All right. I use other people's money for about 70% of most deals, right? That's what I'm using to buy properties. Sometimes it's less, sometimes it's a little more, but we're leaving ourselves to make sure that we have enough money to put that down payment in, so that not only do we have the down payment, so we prove to ourselves that we have the ability to build up that fund, but also that we can get ourselves out of a mess should something go wrong. So be honest about your risk tolerance and your risk capacity. Be clear on your timeline and start thinking about, if it is hard for you to build up this fund, what relationships could you lean on, or what relationships can you look to build so that you can go and get into this world and work together with a team so that you're not feeling all alone on an island wondering how you'll get started. And finally, the last piece here is stay compliant. Don't do something that's going to put you or your family at risk. And of course, if it is illegal and it's not compliant, then it probably wasn't a good idea in the first place. So be cautious out there. Make sure that you're being conservative, and let's build some wealth together. All right, my friends, if you have enjoyed this episode, do us a favor and hit the like button, subscribe, comment, share with your friends and neighbors, and of course, feel free to reach out to us if we can be of any help. Over on our discovery page, you'll notice that we have our pathway quiz there available for you. So you can do it all in one place so that you can understand the 4 stages of wealth building and where you are at each of those stages. Head on over to CanadianWealthSecrets.com/discovery and take that short quiz so that you can figure out where you're having some success and where you might want to focus your attention next. And just as a reminder, my name's Kyle Pierce, and I am a licensed life and accident and sickness insurance agent, and I'm the president of Canadian Wealth Secrets Incorporated. And this is not investment advice. It is not for tax, legal liability, any type of advice, including accounting advice. So please make sure you do not construe any such information as such. It is for entertainment purposes only, and we look forward to seeing you in the next episode.